Okay, students, we're back and we're going to start with brief exercise 21.3. So let's go to the problem. And Leroy Lawn's inventory increased during the year by $6 million. Now let's just stop and think about that one for a minute. So if their inventory increased by $6 million, that means that we bought $6 million more worth of inventory than we sold in cost of goods sold. So what does that mean? That means potentially cash flows to suppliers of inventory were $6 million more than our cost of goods sold. So in our summary entry, the way we increase inventory is to debit inventory. So we're going to have a debit to inventory for $6 million. Now, its accounts payable increased by $5 million during the same period. So let's just look at this totally independent of that first fact. Accounts payable increased, that means we credit accounts payable. Now, what's the effect on that of comparing cash flows and cost of goods sold? Well, if accounts payable went up by $5 million, that means we had $5 million more in purchases than we paid for. So what does that mean? Well, cost of goods sold is what we sold, but we didn't pay for everything. So our cash flows to suppliers were $5 million less than our cost of goods sold. So in other words, if our cost of goods sold, we see there 25 million, and we had an increase in accounts payable of 5 million, well, that means just looking at that one independent of the first one, we would have only paid suppliers $20 million because $5 million of that is still owed. Now, again, just think about a zero balance. So if we started with a zero balance in accounts payable and we bought $25 million worth of goods and sold them all, again, we're ignoring the $6 million there. We bought $25 million worth of goods and sold it all. Then we had $25 million in cost of goods sold. But if we have $5 million in accounts payable, we started with zero in accounts payable. We bought $25 million worth of goods, so accounts payable went up to $25 million. We only paid $20 million to wind up with a balance of $5 million in accounts payable. So then what's the amount of cash Leroy paid to suppliers of merchandise during the reporting period if its cost of goods sold was $25 million? Prepare a summary entry that represents the net effect of merchandise purchases during the reporting period. Now again, these summary entries can really help you sort all this out. So $25 million in cost of goods sold. Cost of goods sold is an expense. It's a debit. Increase in inventory is an increase in an asset, so that's a debit. So we have a debit of $25 million for cost of goods sold and $6 million for the increase in inventory. Now the increase in accounts payable is a credit of $5 million. So we have $25 million debit, a $6 million debit. That gives us $31 million in debits. We have a credit of $5 million to accounts payable. So there we have those, the debit to cost of goods sold, debit to inventory, credit to accounts payable. So to get this to balance out, what do we need? Well, a $26 million credit to cash. In other words, cash paid to suppliers was $26 million. Okay, I hope that makes sense. If not, watch the video 2 or 3 times and just follow it through and make you some T accounts if you need to, and just trace it through. Okay, let's move on to brief exercise 21-4. Right here, Sherry Ann Baby Products salaries expense was $17 million. What is the amount of cash Sherry Ann paid to employees during the reporting period if its salaries payable increased by $3 million? Prepare summary journal entry, that represents the net effect of salaries expense incurred and paid during the reporting period. Now again, we have salaries expense of $17 million. That's going to be a debit. Salaries payable increased by $3 million. So if salaries payable were zero at the beginning of the year, they're $3 million at the end. What does that mean? That means of the $17 million in salaries expense, only $14 million was paid to the employees in cash during this year. So the salary payments in cash would be $14 million. We have a debit to salaries expense for $17 million. We have a credit to salaries payable of $3 million and a credit to cash of $14 million. Right here, there's the debit to salaries expense, credit to salaries payable. So the difference is the amount of cash paid to employees. All right. Let's go back to the chapter and pick up from there. So cash flows from investing activities. I showed those to you a little bit ago. Remember right here, pay attention to this. Cash flow outflows and cash inflows due to the acquisition and disposition of assets other than inventory and assets classified as cash equivalents, and also except for trading securities. Trading securities are considered, the gains and losses on those, the money spent on those is considered operating activities because they're only trading securities if you're in the business of trading those. That's part of your operations. So other than inventory and assets classified as cash equivalents and trading securities are reported as cash flows from investing activities. So outflows and inflows of cash due to the acquisition and disposition of assets other than inventory and cash equivalents and in trading securities. Okay, book explains all that in here. Again, investment revenue like interest and dividends or other cash returned from those investments is not an investing activity. The reason, remember, is that investment revenue is an income statement item and therefore is an operating activity. Okay, and they walk you through that. We talked about purchase of land is an outflow from a investing activity. Purchase of short-term investment that's not a trading security is use of cash or cash outflow from investing activities. Sale of land and sale of equipment are cash inflows, are sources of cash from investing activities. Okay, financing activities, cash inflows and cash outflows due to the external financing of a business are reported as cash flows from financing activities. Now, external financing means borrowing and money invested by owners. So transactions with your own stockholders and with lenders. Now remember, interest payments are an operating activity, but dividend payments are a financing activity. Now, if you own stock and you receive dividends, dividends received on stock that you own is an operating activity. Okay, cash flows from financing activities include the sale or repurchase of shares, that's your own shares, your stock you sell, or your stock that you repurchase as treasury stock in your company. The issuance or repayment of debt securities, and that's the principal amount only, and the payment of cash dividends. Now your book explains all that up in here too. So and right here, sometimes a cash receipt or a cash payment relates to more than one type of activity. For instance, proceeds from an insurance policy might be for a fire loss for a building that contained both equipment in use and inventory for sale. In that case, the cash proceeds pertaining to the building and the equipment is an investing activity, and the part pertaining to inventory is an operating activity. It's not always clear how a cash flow should be allocated when the nature of the cash flows cannot be determined by first looking for GAAP guidance. The classification should be based on the predominance principle, that is, judgment based on the activity that is likely to be the predominant source or use of cash flows. Okay, let's do some more homework problems. So we see here, this one you can't really tell, but that's a 10. So we're going to do brief exercises 5 through 10. I'm going to run out of time before we get anywhere near done with those, but I'll start on this video and then finish up on the next one. So let's go down to brief exercise 21-5, and there it is. So Agee Technology, Inc. issued 9% bonds dated January 1st with a face amount of $400 million on July 1st, 2021 at a price of $380 million. For bonds of similar risk and maturity, the market yield is 10%. So that explains why they sold them at a discount. The market rate was 10%. The stated rate was 9%. So when the market rate is higher, or the yield to maturity is higher, then we're going to sell the bonds at a discount. Interest is paid semi-annually on June 30th and December 31st. So we're selling those on July 1st. So the first interest payment period is going to be December 31st. Prepare the journal entry to record interest at the effective interest rate at December 31st. What would be the amounts related to the bonds that Agee would report in its statement cash flows for the year ended December 31, 2021. Now, in its statement of cash flows, it's going to have to report the amount of cash interest paid. So that's 9% times $400 million times half a year. So that is all going to be reported as the cash outflow. Now, interest expense on the effective interest method, that first year, we haven't amortized any of the premium or discount, is going to be $380 million cash that we received, net book value of the bonds, times the 10% effective interest rate, times half a year. So bond interest expense is going to be $19 million. Now, how much cash did we pay? 9% times $400 million times half a year. That's $18 million. So we have had $1 million in discount on bonds payable amortized. So how much do we show as the cash flow? Well, we would show as a cash inflow the $380 million from the sale of the bonds. That's the amount of cash that we received. And for interest cash flow payment for interest, $18 million.